Welcome and thank you for joining PwC's webcast, Temporary Away from Home Rules, Comparing and Contrasting Canadian Regulations with Other Common Expat Locations. This webcast will run for approximately 60 minutes. Before we begin the session, we have a few reminders. For a better viewing experience, please close all other applications. To ensure you can hear today's webcast properly, please make sure the volume on your speakers is turned up, in addition to the volume control on the media player. For better sound quality, please use headphones. If you experience difficulty with the audio, please press F5. To print a copy of the presentation, please click on the green Resource List widget and then select Download Slides. If you have trouble reading a particular slide at any point, to enlarge it, simply click on the green Slide Max button in the top right corner of the slide area. At any point during the presentation, please feel free to submit a question by typing it into the Q&A window located on the left-hand side of your screen and then clicking the Submit button. We will attempt to answer as many questions as possible as they arise or during the Q&A session at the end of the presentation, time permitting. Polling questions will also be posed during this live webcast to enhance your online experience. Your full participation in today's webcast qualifies you to receive 1 hour of Continuing Professional Development or CPD credit. Please note, in order to receive this CPD credit, you must be present for the entire live webcast and participate by responding to the 4 live polling questions that will appear on your screen at intervals throughout the presentation. CPD credit cannot be awarded for participants who are not logged onto this webcast as themselves, participate over the phone, or attend the on-demand version. For those qualifying for CPD credit, a certificate will be sent shortly after the webcast to the email address used for registration. The certificate will acknowledge 1 hour of structured learning towards the Institute of Chartered Accountants of Ontario CPD requirement or similar accreditation. For those webcast participants in other jurisdictions, you should follow up with your local governing body to confirm if it meets requirements. This entire presentation will be archived and available for later viewing. And now I'm pleased to introduce Chantal Farrell-Carter, our moderator for today's session.
Good day all. My name is Chantal Farrell-Carter and I'm a partner with PwC in the International Assignment Services Group. With me today are Martha Cattell, the practice leader of the IAS team in Montreal, and Teresa Malawani, a senior manager in our IAS Montreal team as well. More and more, all companies of sizes are globally leveraging mobile workforces to pursue new business opportunities and to assist with skill gaps and to address talent shortages in other locations. Compound this with companies also seeking to control costs over the delivery of assignment benefits, yet still remain competitive in the market so they can retain talent. A core component to most of your relocation policies is temporary housing, meals, and travel benefits. Knowing how to deliver these benefits in a tax-efficient manner in both the home and the host locations is key to controlling costs, especially for those employees who are tax equalized. Many countries do provide some tax concessions for temporary assignments, depending on how the benefits are delivered and for certain periods of time. The objective of our session today is to compare and contrast the tax relief provided by Canada to that of the US, UK, France, and Australia, and to highlight what actions or documentation may be required to take advantage of the tax relief in each of these locations. Note that we are not tax experts of jurisdictions outside of Canada and the US, but we will provide you today with a high-level overview of the concessions offered by each of the other countries. We're now going to have our first polling question for the presentation. We would like you to indicate which countries you are most interested in hearing about today. And please note that you can indicate more than one country in the polling question. While we wait for the polling results to come through, Martha will go through the agenda for today's presentation.
Hello, everyone. Chantal covered the objectives for our session, but I wanted to go over some of the other points on our agenda. We're going to look at what temporary and living expenses are and define those terms in our common vocabulary and also in a tax environment. We are also going to look at Canadian tax relief. That's going to be our basis for the relief and for the rules that we provide. Chantal, I think we already got the results of our polling question.
Yes, as everyone can see on the polling results, most individuals are interested in hearing primarily about the U.S., Canada, and the U.K., with some interest in France and Australia as well. We will definitely spend time on those particular countries, and for those who do have an interest in more than one country than the other, we are looking forward to your questions that you will submit on those countries.
All right, back to the agenda. Now, we're going to compare the countries that we asked the polling a question about. So we're going to look at the U.S., the UK, France, and Australia. And we're also going to provide you with some planning points and the specific things that you need to remember when you're looking at setting up temporary assignments. First thing I'd like to start with is, what's the definition of the terms temporary and living expenses? We thought it'd be fun to put up here the definitions from Webster's Dictionary. We all know what these mean. We use these terms every day. However, when you move into the tax arena, the definition of these terms changes dramatically. And also, the terms change in every different country. So what's temporary in Canada may not be the same as temporary in the UK when we're looking in the tax arena. Let's start with Canada. As I said, we're going to use Canada as our base, and we'll compare all the other countries back to Canada. In Canada, we have a special exemption for board and lodging at special work sites. We often refer to that as Section 6.6. That's the section in the Tax Act. The general rule in Canada for all taxable items is that any benefit received by an employee is taxable. So basic rule, if you get a benefit, you're going to pay tax on it. However, under Section 6.6, we have special exemptions that are available for board and lodging that relate to special work sites. Now, you do have to meet very specific conditions in order to get this exemption. First of all, the employee has to work at this special work site carrying out duties of a temporary nature. Well, what does temporary mean? In the Tax Act, there's no definition for temporary, but there's an interpretation bulletin and court cases which say that usually temporary means 2 years. The second condition is you have to be away from your principal residence for at least 36 hours. So it can't be a short business trip. You have to be away from your home for at least 36 hours. The final condition is that the employee keeps a self-contained domestic establishment, so a rental or a house, whatever, in their principal place of residence. Basically what this means is this property, this establishment, has to be available to the employee. It cannot be rented out to a third party. One thing to note is these expenses, as we mentioned, the board and the lodging, are non-taxable to the employee, but anything that relates to the spouse, the dependents, or the family members in terms of board and lodging, that's going to be fully taxable. So if you give an allowance to a family, you're going to have to figure out what piece of that relates to the employee and what piece relates to the rest of the family. One thing I'm going to add here is what exactly is board and lodging? Again, unfortunately in the Tax Act we have no definition. But when we look at the interpretation and the guidance provided by the CRA, by Revenue Canada, we're usually referring to meals, accommodations, utilities, maintenance, your everyday general living expenses. Now, moving on to one other item, which you would not expect when you look at the title, board and lodging, but you are able to get an exemption for transportation. Now, it's very specific transportation benefits. It's basically the value of free transportation, so you, the employer, pay for the employee to travel back and forth between his special work site and his principal residence. Or you provide an allowance to your employee for these transportation expenses. One thing to note, this cannot be for local transportation, and we get this question all the time. You have an employee who goes from Canada to the U.S., you provide a car in the U.S. so that employee can get around easily. The value of that transportation provided in the work location will be fully taxable. Now, there's another interesting thing I'll mention here is home leave. Home leave is where the individual can go from the work location back to their home location, and it's specifically back to their home location. And the question is, well, okay, that works for the employee. We can exempt it for the employee. However, is that exempt for the family? Usually under our rules, we said, well, expenses for family are taxable. However, there is a CRA letter that specifically states that if it's home leave between a home location and a work site for family, it can be excluded from tax only if it is reasonable. And of course, we have no definition for what reasonable is, but clearly it has to be between the home and the work location, and it cannot be extravagant. Now, in order to get these exemptions, you do have to have specific documentation in Canada. And a lot of people forget about this because this form is not filed with the government. The form is a TD4, Declaration of Exemption, Employment at Special Worksite. It can be downloaded from the CRA's website. Now, this form should be done for every short-term assignment. It should be completed and signed by the employee and the employer. And what's basically happening on this form is that the employee is attesting that they meet the rules, as we defined earlier, and the employer is saying also that I know or I understand from the information provided that my employee meets the rules. Again, it's not filed with the CRA, it's simply kept in the payroll files. Now, in terms of T4 reporting, there is nothing specific here required when it's a special work site. But if you have an individual going into what we call a prescribed zone, then that would have to be reported on the T4. And we're not talking about the prescribed zones like the Northern Territories today.
And Martha, there's one more thing I'd like to add about this TD4 form. So the question often comes up from our clients, well, when exactly do we provide this form to the employee? How can we make sure it gets done on a timely basis? And what we found, and we've been very successful with, is actually providing this form during a tax consultation. So when your employee meets with a service provider to discuss the tax consequences of their assignment, this form can actually be provided to them. They can take a look at it, sign it, and then provide it to you, the employer, to keep on your payroll file. Another thing that can be done is that at the time that the offer letter or the assignment letter is actually given to the employee, that is actually included as an addendum.
Those are really good points because it's something that if you put it out there, you're probably going to remember to do it. All right, on our next slide, we've given you a copy of the form. I know it's very, very small, but at least it gives you a little idea of what's required from you.
And just to draw your attention to something on the form, you've noticed that the amounts are actually being requested with respect to the accommodations being provided. These are estimates, so you can actually pull these amounts off of the assignment letter and use them, and then the employee can sign based on the fact that it's in his assignment letter.
That's a good point. Let's look for a moment at Quebec. Quebec's rules for temporary assignments are very similar to Canada. So you can basically rely on the rules we've provided, but there is a very important distinction. And we have had clients audited on this point, so it's important to remember this. The duties of the work also have to be of a temporary nature. The duties that are relating to the position. It's not simply the amount of time that the employee is on assignment. So what we're looking at is that the individual is doing project work. In the mining industry, the technology industry, the oil and gas industry, you're going to work on a project for a specific period of time. Once your duties are completed, then your assignment is over. This does not apply to roles that are more management-based. So if you have a temporary employee who comes up to take the role of a general manager or an operations manager, that may not be considered of a temporary nature. Now, if all the conditions are met as we mentioned, including those for Canada, plus this one of temporary for Quebec, then the value of the benefit will not be taxable in Quebec, but you do not, and I should say, You do not have any reporting requirements on your Relevé 1 slip. There's nothing special for Quebec to keep in your files. The TD4 will generally be adequate if you get audited by Quebec. Now let's move on to a scenario to sort of enhance what we've learned here. We have an employee from the U.S. who's transferred to Canada. She's going to be in the position of a CEO. Now, in the past, this position has always been occupied as a rotational type of duty by employees from foreign jurisdictions for a maximum of 2 years each. Her assignment letter clearly states that she's only going to be in Canada for 2 years. The company provides her with a housing allowance, but she keeps her home in Connecticut and she returns there once a month. Now, let's assume that this employee is transferred into Quebec. Can we exempt her housing allowance under subsection 6.6?
Well, if we actually go through the steps of assessing whether she actually qualifies, first and foremost, we'd be looking at the duration of the assignment. So it says a maximum of 2 years, so we're standing by the administrative guidelines for the length of the assignment. The next thing, especially since she's going to Quebec, is looking at the type of role that she's taking on. Normally, CEO is considered more of a permanent position. However, it's actually been mentioned here that it's a rotational role, so it's actually not permanent, it's temporary, and it keeps on changing every couple of years. So that would qualify for the temporary as well. She's away from her principal residence, which continues to be available to her. So based on these factors, she would in fact qualify for 6.6. And then it would be very important to have that TD4 on file signed by both her and her employer.
That's an excellent summary, and this shows you some of the planning you can do. We said temporary in Quebec is not necessarily considered short-term if the position is not with temporary duties. However, in this situation, we do have a fact pattern that we can make work so that you can get the exemption. Now, I think, Chantal, we have another polling question, right?
Yes, so polling question number 2, we are asking our audience, is the review of whether an employee qualifies for an exemption under 6.6 integrated into your mobility process? So the answers could be yes, no, or sometimes. So while we're waiting for the polling questions to come through, I'm going to answer some questions we received from the audience. So the first question we received, would CRA ever ask for the TD4 from the employee? I would say I have seen that actually when we receive a request for information from the CRA. In the situation where the employer does not exclude the housing off the T4, but the employee does qualify for the Section 6.6, we've had to report the T4 and then take a deduction for subsection 6.6 on the return. And in that particular case, the CRA has come back and they have requested the TD4 from the employee. So normally it would be part of a payroll audit where they would go to the employer to get the TD4, but in that specific case to support the deduction on the return, they have asked for TD4 from the employee. Another question that we've got from the audience. I have a Canadian employee working in Australia that uses their home leave allowance to go on a family vacation to locations other than home. Is this still non-taxable?
Chantal, let me answer that question because I actually have had some clients in that situation. And in fact, they're not using their home leave to go back home. They're using it to take a personal vacation. So it actually is a taxable amount and cannot be exempt under 6.6.
Good. And those are commonly known as flights in lieu. So for those who are more accustomed to the expression flights in lieu, the flight in lieu is definitely a taxable benefit. So we're now going to push through our polling results. And the answers we received from the audience, it's about even for those who do or do not include it in their mobility process. So it's interesting that we have a mixed response there. Definitely, as Teresa referred to, it's better to actually have it done at the start of the assignment, before the assignment, as part of the pre-assignment consultation. And where I find that good for the companies is that it also gets factored into your cost analysis of the assignment. So you may find that when it comes down to choosing a candidate where you have a choice of two, one may qualify for 6/6 and the other may not, you may actually choose the one who meets the exemption only because it results in a lower cost. Okay? So on that note, we're going to move the presentation on to Teresa, who will now discuss the away-from-home expenses from a U.S. perspective.
Thank you, Chantal. So now that we've seen quite a bit of Canada, let's look south of the border. So the U.S., away-from-home expenses, what exactly are they? What do they constitute? Well, what the U.S. has come and said, or the IRS, is that for travel expenses to qualify, first and foremost, they need to actually be ordinary and necessary, which simply means that they need to be common and accepted in your line of business and helpful and appropriate for your business as well. The other thing is they would have to be incurred in the pursuit of the work that is being done. Finally, and this is what we're going to actually spend a lot of time on, is they have to be incurred while the employee is away from their tax home. And there's a subtlety here. It's tax home, it's not tax residency. So we'll get into that in a few minutes. Finally, a little different from Canada, the duties require the employee to be away from their tax home for longer than 1 day. So Canada is looking at 36 hours, the U.S. looks at 1 day. The other difference with Canada is temporary has been defined administratively in Canada to be about 2 years. In the U.S., they're a little more strict about that. Temporary has actually been defined as being less than a year, and we're looking at the intent related to the work away from home as well. So if we look at to the types of expenses, just to give you guys an idea of what can actually be exempt, we've got lodging and meals. We have transportation between home and work location, as well as transportation locally while the person's on the trip. So contrary to what Martha was saying before, where she was actually saying for Canadian tax purposes, if an employer provided a car to the employee while they're working in the U.S., that would be taxable for Canadian tax purposes. For U.S. tax purposes, if all the rest of the criteria are met for the away-from-home expenses, it actually would not be taxable. Finally, there are incidentals such as laundry, dry cleaning, or tips that would fall under these expenses as well as per diems. And in the U.S., the per diems, there are published rates by the IRS where they really truly define the reasonableness of the per diem, and that's what you would have to abide by. So let's get into the definitions a little more. Nothing more exciting than a good definition, I think. So tax home, what in fact is an employee's tax home? It's defined to be their regular or principal place of business. Now, if you have an employee that has more than one place of business, so let's say they spend 80% of their time in New York and they spend 20% of their time in California, what is their place of business? What is their tax home? Well, we have to then look to the main place of business. So in this case, because it's more weighted towards New York, it would actually be New York. Now, we also, when we're determining the main place of business, would look to the time spent in each place, as I just discussed, the level of business activity that the individual had in each location, as well as percentage of income derived from each location. Finally, and I had gone into this a little bit before because I got ahead of myself, but what is temporary? Well, for U.S. tax purposes, it's defined to be less than a year. If it's in fact more than a year, it's actually considered to be indefinite and your tax home shifts. So then you would not qualify. Now, maybe I'll give you a little example of that. So if an individual is on assignment for about 9 months, 6 months in, the project actually is thought to be longer than originally planned, and it extends out to 18. So at that point, it's actually determined that the individual will be out for longer than a year. So from that point onward, it's not considered to be qualified for away-from-home expenses any longer, and on a prospective basis, that would be taxable. Now, in the U.S., of course, as in Canada, documentation to substantiate the expenses is critical. And also to note, any expenses incurred for any spouses or dependents that are accompanying the employee are taxable. Because tax home is so important, we'd like to go through a scenario that really brings that point home. So we've got an employee who is a CEO based out of the U.S. She also works in Australia, in Canada, and the UK, all countries near and dear to us for today's presentation. She spends approximately 25% of her time in each country, and she's a resident of the U.S. for tax purposes. Where is her tax home?
Yeah, you're right, Teresa. This gives a good definition of tax home because we're looking at an individual who's spending her work duties, if you like, in a variety of different places, and they're all equally weighted. So how would we determine where her principal work location is? We'd have to default back to the U.S., which is where she is a resident, so that will also become her tax home. So therefore, any expenses for her traveling away from her U.S. home, if they qualify for the other criteria, would generally be exempt.
And that's a point to bring home, which I didn't mention during my definition of tax home. If the individual is really working in a number of locations, such as this CEO, then really it goes back to where they regularly live, as Martha mentioned. What we've done is actually provided you with a little table. It's a takeaway, which actually compares and contrasts the U.S. and Canada. And just 2 points to drive home. The U.S. looks at tax home, not principal residence, as Canada does. And with respect to the temporariness of the assignment, it's really at less than a year or intent. So if the intent changes through the less than 1 year assignment, then from that point forward, it would no longer qualify for away from home. So now we move on to our next polling question, Chantal.
Yes. So polling question number 3 to our audience. Does your company have employees with multi-jurisdictional responsibilities? And by multi-jurisdictional, we could be regional or it could be global. More and more we're finding companies, their C-suite employees are taking on more of a global or regional role. So we thought this would be a good intro to the next section on the UK. But before that, while we answer the polling questions, we're going to answer a couple of questions from the audience. So one question we have, Martha, is not clear on how long temporary is. Can't be more than 2 years. Can it be more than 2 years?
This is a great question because we have to look at what country are we talking about. So let's say we're looking at the U.S. The U.S., as Teresa said, if the original intent is more than 1 year, then the employee is going to be taxable on allowances and the assignment will not be temporary. So for the U.S., temporary is 1 year or less. For Canada, I think that's what this question is referring to. We're at that point, it's not clear what temporary is because in Canada they don't tell you. There's no definition. The guidelines tell you it's 2 years. So generally, we would recommend set up your assignment length for 2 years. But if you have an employee who's coming in to do a project that you know is going to last 2.5 years, let's say, or maybe even 3 years because that's the contract with your client or that's the length of time that it requires to do the particular job at hand, then you could push it to 2.5 to 3 years. We rarely see anything go over 3 years, however, unless it's a very unusual circumstance.
And to support that 3 years, there actually have been some letters from 2011 from CRA that support that 3 years would qualify as temporary.
Okay, and again, what it comes down is the definition of what are the duties. So as long as the duties are considered temporary in nature, then you should qualify under 6.6 because there is no mention of a length of period of time in the Act. So it all comes down to administrative practice and interpretation. So we're going to go to our polling results. And the answer is yes. So as you can see, the good majority of our audience do have CEOs or CFOs or employees who have global responsibilities. And I know these types of arrangements because we do get a lot of questions from our clients with respect to these types of arrangements. And where the confusion lies is respect to how do they treat the travel expenses. A lot of companies will assume that the travel expenses are business and therefore are not taxable. However, you really need to look closely at it and apportion the expense to determine what is business expense and what is actually reimbursement of personal expense. Think of it as this way. If PwC were to reimburse me for my GO train travel from home to work, that's a reimbursement of a personal expense and it would be taxable. So when you have a global CEO who lives in Toronto but works in New York, and you're actually reimbursing him for his travel back to his home in Toronto from New York, that could be treated as a personal expense. And it's likely that portion of your reimbursement would be taxable. So you really need to analyze each situation for its facts and circumstances. We cannot take a cookie-cutter approach to anybody who has this type of work arrangement, and a deep analysis has to be performed, as well as there can even be some planning around it, so that when your CEO returns back home to Toronto from working in New York, maybe he attends a meeting in the Toronto office so that you can structure it so that it's actually coming back to Toronto for a business reason and not for travel back home. So very important, if you have those types of arrangements, do not assume all the travel expenses of business and seek out advice from your service provider. So on that note, we're now going to move back to Martha, who's now going to look at the rules in the UK. Sorry, to Teresa, who will look at the rules in the UK.
As much as Martha really wants to do this section, I've claimed it away from her. So now we'll be talking about the UK, and we'll just provide you with some highlights with respect to special tax rules of foreign travel. There are a number of different types of relief available, and we'll just be focusing on a few today. So the UK does have special rules for UK residents working abroad, both for those employees who are working 100% out of the UK or those who only spend a portion of their time outside of the UK. But for the purposes of this presentation, we'll be focusing only on the employees coming to work from another country into the UK. Okay? These are employees who are not domiciled in the UK but work in the UK. The special relief that we'll be looking at is commonly referred to as detached duty relief or temporary workplace relief. And when is it actually applicable? Well, first and foremost, it's typically for assignments that are out for less than 2 years, and the employee must be working away from their normal work location. Now, what exactly qualifies? Well, the cost of travel between the home and temporary workplace, similar to Canada. Reasonable costs of housing for the employee only, again, very similar to Canada. Daily meals for the employee only as well. So again, we're saying the employee only. The family would not qualify. Okay? Now, typically, this is for assignments that are for less than 2 years for the detached duty relief to apply. Typically, the individuals are residents of the UK. Now, if the assignment is longer than 2 years, we'll be going to that in a sec, and we're going to be looking at overseas workday relief. One important thing to know, and this is the difference between the US and the UK, is if there's been a change of intention during a tax year, so tax year in the UK being April to April. So for instance, you've got an assignment that was initially supposed to last 18 months, and then at month 11, it's been extended to 2.5 years. Then an adjustment must actually be made from the beginning of the tax year. Okay, so it's a retroactive adjustment, not a prospective adjustment from a payroll perspective. Another item to note as well, for relocation in the UK, so if you provide an amount for relocation, up to £8,000 can be paid out tax-free. However, as with all jurisdictions, supporting documentation regarding the expenses is required. Now, as we move on to workday relief, or overseas workday relief, foreign employees are now eligible for this relief, and the relief is two-pronged, so to speak. You've got relief with respect to expenses. So the relief would qualify if the duties are carried out abroad only. Then the travel costs to and from the overseas worksite can be exempt. No limit to the number of trips. And if the employee is kept abroad for 60 days or more, then the spouse and children's travel costs are exempt as well. Finally, the overseas workday relief also looks at compensation. So an estimate would have to be made at the beginning of the tax year with respect to the individual's travel outside of the UK, and then a reduction of withholdings can be sought to reduce based on the overseas work days. One very important thing to note, though, is that if you, let's say that the individual is going to be out of the country for 40% at the onset of a tax year, and the reality is it's more like 25. If you've received that approval for the reduced withholding and you've actually withheld with the 40%, then you'll be penalized for having actually under-remitted tax. So you have to be very careful with that approval and the estimates that you're making with respect to overseas work. With respect to the overseas workday relief as well, there are a couple other costs that are have tax relief. One is the cost of any inoculations, and the other is the cost of any visas required. Just to highlight, the UK also has new rules with respect to residency and the definition of residency. So not only is the monitoring of workdays very important for overseas workday relief, it's also very important in terms of residency determination. Also to note, any travel must be included in payroll, but no withholding is required. With respect to housing, what's very interesting is if it's paid out as an allowance, payroll withholding is required. However, if it's paid directly, no withholding is required provided an application has been approved. And as mentioned before, approval is required to reduce any remittances. That period of approval can be lengthy, and overestimates on foreign workdays can result in penalties. Very important to remember that.
Now, Teresa, I know we spoke to our UK colleagues to get these rules, but I think they also said that in practice, because it takes so long to get any relief of withholding, et cetera, that they're generally moving to situations where they will pay the housing directly. Is that correct?
That's true. It's a lot more common than it used to be.
So this is something you might want to consider when you've got employees going into the UK. Does it make sense for you, the employer, to enter into an agreement with the landlord and pay that housing directly? I know we often hesitate to have companies get in the middle of that because the lease is usually between the employee and the landlord, but it might be something to consider.
Great. So now just to kind of sum that up before we move on to an example, we have the same table we had done for the U.S. where we're contrasting and comparing Canada and the U.K. And the only takeaway that we really want to highlight here is in terms of the duties of a temporary nature, for detached duty it's 2 years, similar to Canada, but there's also overseas workday relief to consider if you don't meet DDR. So we have a scenario that we'll run through quickly to tie up the UK. We have a Canadian who actually is a resident Canadian on short-term assignment to the UK. He's retained his home in Canada and actually returns home for a week every month because his families remain there. He works in the UK office while he's in the UK, and he actually works at the offices in Toronto while in Canada. His assignment length is expected to be 2 years. So what tax treatment are there for assignment benefits in Canada and the UK?
Well, for Canada, I'm going to assume that it's a short-term assignment and it's 2 years, and the individual keeps his home, so I'm going to assume the individual is going to qualify for Section 6.6. And therefore, we are going to be able to exempt any allowances that are related to housing, board, lodging, et cetera, plus any travel between the two countries. But I don't think from the rules you just gave me, Teresa, that it's quite as easy for the UK.
Well, in the UK, based on the information that we currently have, he would qualify for detached duty relief. So we can exempt housing for him, travel for him, meals for him. Perhaps if his assignment became longer in nature, then we'd have to reconsider. He wouldn't qualify for that, and we'd have to look to overseas workday relief, and then it gets more complicated from a payroll perspective. With that, Martha will start talking about France.
All right. I love talking about France because it makes me think of good food and good wine, but I have to stick to the tax facts. So in France, we have rules that relate to inbound versus outbound. And the rules are quite a bit different than they are for the first 3 countries that we just looked at. So the first 3 countries we were talking about, temporary assignments, away from home, specific allowances. What we look at for France is, first of all, is this person an inbound? Are you inbound into France, or are you going from France outbound? The regime that they have is basically an exemption of supplemental wages. And there are 2 options for inbound. So I'm looking at employees coming from outside of France into France, and the first option would be this exemption of supplemental wages. Now, they do not specifically carve out exactly what types of things can be exempt. They're only talking about allowances paid as a result of relocation, or with respect to any employee that's recruited from outside of France who comes into France. And if you don't want to specify any of those allowances, then you could just say, all right, a supplemental amount up to 30% of their salary. That could be exempt from tax for an individual who's relocating. No timeline required, no temporary nature, no tax home, nothing. The other thing you can do for France is similar to what we mentioned in the UK, this detached duty or working outside the country. You can prorate the income that's related to the work performed outside of France as long as the work is performed for the direct benefit of the French employer. So you have a person from Canada who comes into France to work, and then you send that person down to Spain to do some work. As long as the person's going to Spain to do the work for the French employer, you could exempt the pro rata share of the employee's wages related to that from taxable income. Another thing for France under this first option is you can exempt duplicate living expenses or frais de double résidence. What we're saying here is you've got a home in Canada, you've got a home in France, I have expenses on both sides, so I'd be able to deduct the duplicate expenses in France from taxation.
One important thing to note about France, though, with respect to allowances provided for housing, they're fully taxable in compensation. However, there are special rules in France where if the employer actually provides the housing, either they own the house or they pay the rent directly, then the taxable benefits actually assessed based on fixed rates provided by the French Social Security Administration. So that can wind up in some tax savings.
That's a good point, Teresa. Let's go to option 2, which is our exemption of supplemental wages for inbounds to France. Option 2 is a specific impatriate regime referred to as the régime des impatriés. What this applies to is employees and management who are coming from outside of France, and they're filling a specific position at a French-based company. The conditions that need to be met for this to apply is the employee began the position as of January 1st, 2008 or later. The employee has not been a French tax resident during the 5 calendar years preceding accepting that job in France, and the employee must become a tax resident of France. So if I look at this in option 1, big differences aren't jumping out at me, but what I look at is the difference between option 1 and option 2 is that for option 1, it doesn't matter if you're working for a French-based company. In option 2, you have to be working for a French-based company. And in option 1, you do not have to become a resident. However, in option 2, you do have to become a resident. Now, if I move on to the next slide, I'm going to look at some additional exemptions that are available for this régime des impatriés. So you can exempt an amount for a special expatriation premium or a prime d'impatriation, and any remuneration that's attributable to the services abroad, you can limit those to 50% of the total remuneration. But the portion that's exempt from remuneration relating to services rendered abroad, it's limited to 20% of the taxation compensation from the activity, net of the allowances. So one thing I would say with France is the rules are very specific, and we would always contact our office in France to get very specific guidance to make sure that this applies. Now let's look at a summary chart. Oh, I'm sorry, I'm looking at actually employees going abroad. Before I summarize, I think it would be good if I looked at French employees going elsewhere. Our supplemental wages that are paid related to work performed abroad for a French person, it can be exempt from French taxes if we meet 3 specific conditions. The amounts are paid with respect for work performed abroad for the sole benefit of the employer. The employee has to be at the work site for at least 24 hours. And the amount of the allowance or the supplemental wage that you're going to exempt, it has to be determined at the beginning of the project, and you have to take into account the number of visits, the length of the visits, and the location of the project. So you cannot exceed 40% of the base remuneration. So now I will go to the summary chart. And a couple of things to note. First of all, you have no concept of principal residence, being away from a principal residence or a tax home, as you do in other countries. And the other thing to note on this chart is that temporary nature, it doesn't really apply here either. So you could be working away from your home or away from France or into France for any period of time. There really is no idea of an away from your home for a temporary period. Let's move on to a scenario. We haven't got a lot of information on this individual. We only know that we have a Canadian resident from Ontario who signs a 3-year assignment for a position in France. We do know, however, the person's never been a resident of France. So what's the tax treatment going to be in Canada and France? And do we really have enough information to make a good determination?
Well, I actually don't think we have enough information. The first thing that we'd actually have to do is determine where this individual will be resident while he's on assignment, whether he's a resident of Canada and then may qualify for 6-6, if in fact the assignment is considered to be temporary. Is he actually away from a principal residence that he actually has available to him or not? That's not actually stated either. Is he going to work at a French headquarters? We don't know. So it's really, there's a lot of information missing, and we'd have to actually sit down with him and kind of go through his fact pattern first.
Yeah, you're absolutely right. We need as much information as possible to make a good determination. For us to conclude anything based on this would be very difficult. So let's move on to Australia. Teresa, I believe that's yours.
Great. So Australia, my favorite country, the warmest country at this time of year, I think, as well, of all the ones that we've discussed to date. We're not going to spend a lot of time talking about income tax and income tax exemption. Exempt benefits are available from an income tax perspective in Australia for the use of a car, for accommodations. However, where we really would like to focus is, and where employers sometimes get caught, is with respect to fringe benefit tax. Because something can be exempt from income tax for the employee, but for the employer, they may be actually subject to fringe benefit tax. So what is this fringe benefit tax, or FBT as the Australians fondly call it? It's a tax that's paid actually on most benefits an employer provides to their employee. It's separate from income tax and is paid by the employer only. A separate return needs to be filed by the employer, not the employee. And the tax year for the return actually is different. It runs from March to March versus the Australian tax year that runs from July to June. The other thing is fringe benefit tax is levied at 46.5% of a bit of a complicated formula of the fringe benefit. So it's actually a significant cost to an employer as well. Now, what kind of items fall under fringe benefit tax? We've listed a few for you here just so you have an idea. There's the board fringe benefit, so accommodations and at least 2 meals a day. There's housing fringe benefit, so if you give rent-free housing or reduced rent to your employee. That being said, if the employee is in a remote area, you may be able to exempt the accommodations from fringe benefit tax. So you'd have to seek advice and make sure that you see an Australian service provider with respect to that. There are car fringe benefits. So if an employee has use of a car during his off time from work for private use, that's considered subject to fringe benefit tax as well. And then a lot of the other fringe benefits would qualify as residual fringe benefits. So the item that I'll spend the most time on is the living away from home allowance, or LAFA, as the Australians like to say. It's an allowance that is provided to cover additional expenses incurred because of the requirement to live away from residence. It is for Australian outbound. There have been some transitional rules with respect to this allowance, and now when we're looking at the exemption that's available, it's only for 12 months. And what needs to happen in order to qualify? The home must remain vacant. Well, that's pretty easy. But what's a little different is vacant, it just means it's available to them. They can return to it at any time. So if you have an individual that actually owns a flat with 3 roommates, and he goes away on assignment, and he can return there any time, his room is still available to him, that would qualify. So what does an employer need to do in order to be able to take advantage of this? Well, there are 2 stages to the process. First, the employer must actually provide a questionnaire to their employees regarding to find out whether their home is vacant or not. And then a declaration is signed by the employee where he actually attests to the fact that his place is available to him. We'll look at the form in a second. So now you must be thinking, well, what about the foreigners to Australia? Is there anything available for them? Well, the government wasn't really open to foreigners before. There's been a change in government, and the new administration does seem to be more open to foreigners doing business in Australia. So hopefully there will be some tax relief that will come available in the future. Currently, most allowances attract fringe benefit tax for foreigners. There is an exception. So if temporary accommodations are provided for up to 2 weeks, exempt from fringe benefit tax, so be careful to track that. Work visa for employee and spouse is exempt from fringe benefit tax, as well as tax prep fees. As well, there have been recent cases where for short-term business travelers into Australia or out of Australia, a lot of frequent back and forth, accommodations have been exempt from fringe benefit tax. So that's something very interesting, and to maybe think about how you would structure an assignment to maybe qualify more as business trip or business travel versus a short-term assignment. The other thing, we call it a living away from home allowance. Just to clarify, it can also be a reimbursement of expenses or lodging provided. It actually does not have to be an allowance. So if we move on, just to give you a little snapshot of the form, since we gave you one of Canada, we figured we'd finish off and give you one for Australia as well. It's not very complicated. It's not as complicated as the Canadian one, just asking for some addresses and some dates. So what's the takeaway for Australia? We have a little table for you that you can take a look at. But essentially to remember, if you have people coming into Australia, you wind up with fringe benefit tax. You have to remember, you have to get those returns filed. If you have Australians leaving Australia, they may qualify for the living away from home allowance, and you have to make sure that declaration is signed and on file. So now we move on to a scenario. We've got a Canadian who's sick of the winters here and has decided to take on an 18-month assignment in Australia, where the weather's much nicer. His start date is June 1st, 2013, and he'll be receiving a housing allowance, a per diem, and a car while in Australia. What's the tax treatment in Canada? And in Australia, what are the planning opportunities for this employee?
All right, Teresa, I'm going to start with Canada because I'm most comfortable with that. So I've got an 18-month assignment, equalized to Canada, housing allowance per diem. I'm going to say we need to know if the person is keeping their home, and we need to make sure, because it's Quebec, that the duties are temporary. But if the employee can meet those qualifications, then we could get 6-6 exemption, so we don't have to tax the housing allowance in Canada. We don't have to tax the per diem in Canada. The car, however, in Australia is going to be taxable in Canada. Now, that's going to be a problem because it's paid in Australia and reported in Australia, so you're going to have to make sure that you get those expenses, that information, back to Canadian payroll so they can track it properly. So I'm good on Canada. Now, Australia, no living away from home allowance because that's only for outbounds. I don't think the business traveler applies either because I think that's for outbounds only, so fringe benefit tax on everything. Not so easy?
Well, actually, with respect to business travelers, it's business travelers in and out of Australia. So actually could potentially qualify, but currently it's sounding more like an assignment where he's kind of gone over to Australia and is not really coming back. So it wouldn't qualify for the fringe benefit tax exemption. That being said, he can get 2 weeks accommodations at least, his work visa, any tax prep fees exempt. For now, that's really all that's available. But you brought up a good point about the reporting. So if there are different tax years, different jurisdictions, we have to make sure that there's communication with respect to any benefits provided.
Okay. That's good to know. I think, Chantal, we're down to our last polling question.
Yes, our last polling question for the day. To our audience, do you foresee a greater number of short-term assignments over the next 2 years? Answers yes, no, and don't know. Just to step back a bit to Australia for a bit, in your last scenario, so we had someone who's a continuing Canadian resident, got 6-6, Australia assesses FBT, fringe benefit tax. Will the fringe benefit tax be taxable, accreditable as a foreign tax credit on our Canadian return?
Unfortunately, fringe benefit tax is not an income tax. It's not paid by the employee, so there's no credit across that's available.
So this is something definitely companies have to be aware of because it will increase the cost of their assignment.
For sure.
Because we're not able to recoup that cost on the Canadian return.
Yeah, exactly.
Good. Another question from the audience while we wait for our polling results to come through. France. So Martha, I'm going to put this one to you. We all know French Social Security is very expensive. Do the exemption rules you spoke about apply to Social Security as well? And I know for outbound, as well as inbound, so let's say someone who does not have a certificate of coverage and has to pay French Social Security.
Unfortunately, here's another expense. If you have to pay French Social Security, then these allowances are only exempt from income tax. They are not exempt from French social taxes. So another hidden cost for that assignment that we may not pick up on.
Thanks very much for that. So something we have to keep aware of. So we're now going to see what our polling results are coming through as. And the majority of our audience see that yes, we do expect an increase in the number of short-term assignments over the next few years. So definitely this webcast is of interest because I would strongly recommend that even though the assignments are short, that there is some ability to do some tax planning and structuring around, what type of compensation you're going to deliver, what type of allowances, and for making sure that your assignment letters correct or reflect the correct period of time. And keeping in mind it's not only a Canadian or U.S. issue, we have to get the foreign jurisdiction involved as well to get their feedback on what's a tax-efficient way to deliver those benefits in those countries. So on that note, Martha, I'm going to pass it on to you to wrap up the webcast.
Great. Let's look at this chart that we've put together for you. What do you need to remember? So at a very high level, for Canada, the most important thing you have to remember is that the duties are temporary in nature, not defined, but generally we refer to 2 years, unless, of course, you have a permanent position, and then if you have a person in Quebec and the position is permanent and the duties are not temporary, even though it's less than 2 years, you could run afoul of the rules in Quebec. Also, you need that Form TD4. The United States, the most important thing I think to remember is less than 1 year, or 1 year or less, and the intent, because when the intent changes, that changes your tax treatment. The UK, those rules are complex, but remember you've got a deduction, not an exemption, so you may end up having to report it. The question whether you withhold tax or not is going to depend on whether you get a waiver request in advance. France, we've got this supplemental wage idea. No implications of temporary or not, but you have to remember it's different for inpatriates versus individuals going out of France or expatriates. Australia, our famous fringe benefit tax, and then our business traveler potential exemption, as I learned, for inbound and outbound, as well as our living away from home or our LAFA exemption. On our next slide, we've given you just a little bit more information here for things you want to think about when you're planning your assignment. Clearly, get as much information as you can. Remember that your home location and your host location are not going to provide the same type of relief. Don't assume that and then get caught at the end when the taxes are due. Look at the duties that are to perform and the intent about the length of time. Remember that residency in any country can result in savings. We saw in France, under one regime, if you were a resident, it applied to you. If you weren't a resident, it didn't. Same in the UK. Housing, maybe you want to consider how you're delivering your housing. You might get some benefits in France or the UK. Now, one thing that's interesting, and we've tried to drive this home, is that tax savings to the employee can result in taxes to the employer. So your fringe benefit tax, the allowances are not taxable to the individual on the individual's return, but the employer has to pay that fringe benefit tax, and it is not creditable. Finally, temporary is not the same in every jurisdiction, and we strongly recommend that you have an assignment letter plus any other documentation that you can get to document what the intent is on these assignments. So if you do have an audit, you've got all the information at hand. And that's really what we want you to take away from today's session.
Well, I'd like to thank Martha and Teresa for joining us today and sharing with us all that wonderful information. Unfortunately, we're not allowed to take any more questions at this point in time because we are cognizant that we are hitting the hour. but we will ensure for those who have submitted questions that someone from the team will respond to you and answer the questions. As well, if you discover that you have any other questions post this webcast, we have provided you the list of names, myself, Martha, and Teresa, and our contact information. So please feel free to contact either one of us or anyone on your client service team to respond to your questions. On that note, we'll pass on to our next webcast with some information on some upcoming events. Our next HRS webcast is expected to be held Wednesday, January 2nd in the new year. And we will also be releasing some new podcast series, Top Mobility Issues for Tax Directors to Think About, also in January, that will be available on our Tax Track site. Notification will go out to everyone on the mailing list when these are available. And we also have our recent What If podcast series that is currently posted on the website. We have a URL posted there as part of the presentation where you can access these podcasts if you're interested. So I'd like to thank everyone today for attending our webcast, and I wish you all a good holiday season, and we'll be talking to you in the new year.